Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Matt Miskin of John Hancock Investment Management writing, if you are not easing, you're tightening. The bond market has already priced in 2.5 percentage points in rate cuts over the next 12 to 16 months. If the Fed chooses less than that, in essence, they will be tightening monetary policy. Matt joins us now for more. Matt, welcome to the program. Have you ever, when was the last time you saw a decision this finely balanced, 24 hours out?
I don't remember one. I think 2015 was the last one that I've heard of as recalling this, but it is leaving a lot of uncertainty. And, I think the Fed would like to have more prepared kind of communication around this. And, what we're looking at is, though, not to overemphasize one meeting, one data point. I know retail sales are going to be exciting here in just about an hour, but at the end of the day, we're starting a cutting cycle. That's what we know. We know that inflation has come down a lot and the unemployment rate is rising. Keep it simple. As it relates to that, that means the Fed's going to be cutting. In our view, we could end this cutting cycle with a 2 handle on the 10-year and, frankly, a 2 handle on the Fed funds rate. And that's with just inflation coming down. We see a recession. We think actually we could get a 1 handle on the Fed funds rate and low 2s on the 10-year.
Matt, 2 handles on 10s, 2 handles on Fed funds. Tell me where the S&P 500 is against that backdrop.
Yeah, so that would be assuming a soft landing, which to us means more chop. The problem with wanting more out of the S&P 500 is the valuations are already at the upper end of the range. So we're at about 21 times on the forward PE on the S&P, and then we're baking in 15% earnings growth. So we need earnings growth from here to drive equities. But frankly, there's already baked in massive growth. So it's going to be really hard to get much more out of that. You can make the argument for rotations. We do like that. Right now we're in mid-cap for cheaper ideas across the equity market. And we're looking at some high-quality cyclicals. But at the end of the day, what we're seeing is the bond market still might have about an 8% total return over the next 12 months. We think that's going to be really competitive on a risk-adjusted basis.
It's a pretty radical thought, Matt, the idea of a 2 handle on 10-year notes at a time where some people are saying that the neutral rate is something more akin to 3.5%. Why do you reject the market's expectations of where the Fed's neutral rate really will end up?
Yeah, I mean, starting out with the neutral rate, being around this industry for as long as about 10 years now, the neutral rate has always been almost like a mysterious number that can never be quantified or found out. It almost reminds me of productivity in terms of economists. But at the end of the day, it's a cycle. Soft landing isn't destination. We're always changing and evolving as it relates to the economic cycle. I wish we could just stay in one place, but that's not how it works. If the unemployment rate is changing and shifting like a pendulum to a higher unemployment rate, if inflation is shifting like a pendulum to lower inflation, to us, that means lower rates. And I think one of the things we're anchoring on as investors is still thinking about the COVID era monetary policy, fiscal policy, disruptions to the global economy as the new normal. And it's not. That was a massive outlier that likely will never happen again, knock on wood, in our lifetime. And therefore, if we're back to the way we were pre-COVID, why wouldn't we be back to a lower rate regime? And if it's a lower rate regime, that's actually good for stocks and bonds. It means lower inflation, but it likely means bonds has more catch up after equities have done so well as of late.
So it sounds like you're still overweight bonds relative to stocks at this juncture. What could make you flip that, given the fact that ultimately this is a pretty benign setup for stocks, given the fact that we spent years talking about how low rates really boosted valuations among equities?
So strategically, stocks have done always better than bonds longer term. And so we are just a modest underweight to stocks versus bonds. But the biggest change we made in our tactical views is just overweighting higher quality parts of the market. So on the equity side, we're overweight higher quality markets. technology, U.S. equities, U.S. larger cap versus smaller cap. And then in the bond market, investment grade corporates with about a single A credit quality is about as much credit risk as we really want to overweight. Agency MBS, investment grade corporates are things we like. We were doing 5 to 6% in yield just a couple of months ago. Now we're doing 4 to 5. But again, on a risk-adjusted basis, we think that's really competitive versus stocks here.
Matt, you're not scared of being contrarian. Do you find it uncomfortable that what you're saying this morning is basically what everyone's been telling us now for the last month?
So I hear that a lot, right? Well, I don't hear that a lot, but nowadays we are hearing that everyone's bullish on bonds, right? And utilities, as you said earlier in the show, John, around the fund manager survey, the interest rate sensitive sectors. And I look at the pricing, though, of the market. And I also look at the guts of the market and just cross-asset performance. So we've got gold doing great, the yen doing great, treasuries doing great. Those are all defensive. Those are all saying, hey, the economy's slowing, inflation's slowing. Then you got high yield spreads at super tight levels. The S&P multiple is really high, and it's more small caps are starting to do well. We're getting cyclicals out of Europe doing well. So it doesn't add up. That's the part of the consensus that I don't get. If you want to say that everyone is more bearish or suggesting more rate cuts, there's this other part of the market that is saying that's contrary to that. So I think you just need to be careful with that. When we look at what's priced in, it's a lot of good news on the risk front. And to me, that just needs to be shaken out here because the Fed can't do everything. They can't just cut, consistently and meet up to these expectations and then support everything that has happened here. So we just want to take a more managed, risk-managed approach, a more conservative approach. We're not underweight, we're not underinvested, but that income is a key component, and that's, to us, going to pay off over time.
Matt, just love your thoughts on how we're priced going into tomorrow and how you think we might respond to any given decision. Do you think it's sufficient just to validate market pricing of the dot plot? Is that enough, or does this market need more?
I think that's key, John, to your point, because they could just say 25 or 50, but then it's how do they say on top of that what we're going to do to the end of the year? So in the June Summary of Economic Projections dot plot, they said 5.1 on the Fed funds rate by the end of the year. That was the median. That has to come down to some degree or else the market's going to be pissed, right? Not to overdo it, but it's not going to be happy unless they say on top of this cut, hey, we're still suggesting cuts to come because, again, if they're not easing, they're tightening. And that's okay. If they want to push back on the bond market, if they want to push back on the easing that's already baked in, that's fine. But they got to know that that's what they're doing. And it's a precarious time to really put more tightening into this market. We would follow the bond market. If you want to create a soft landing, you need that. You need tight credit spreads, and you need initial jobs claims to stay low. If you get those three things, you can keep a soft landing. If not, you're probably looking at more risks to come.
Matt, just to sort of underscore one point that you just made about the stock market just generally being pretty ticked off, there is a question about whether this Federal Reserve cares. It didn't really care on the way up. It seems to care on the way down. Is that basically the litmus test that we're working with?
Well, there is a wealth effect to these things. So, consumer net worth through the second quarter hit all-time high, ridiculous trillion dollar amount. But that's probably helping the economy. That's probably helping consumer spending. That's helping consumer confidence. And, the markets are very fickle and volatile, and it's very difficult for the Fed to over-extrapolate things because it could change on a dime. But at the end of the day, they do need to be cautious of being too dovish because, if the wealth effect becomes even bigger, if housing continues to go higher, that's going to lift inflation. And if stock markets continue to go up, we could be cautious here because of more bubble territories. We've had lessons of not overstimulating with ultra low interest rates because it can create bubbles. For us right now, cycle-wise, we want to protect on the downside. I think their dual mandate, they got to focus more on employment than inflation. And that's really what we got to look at. But they've got to use the side of their eye. They've always got to be watching for too much speculative nature in markets. And we're coming off some pretty significant speculation, but it's still not relieved from the market yet.
Matt, just a reminder for next time, we curse in surveillance after hours. That's a podcast coming in Q4, where there'll be lots of cursing, drinking, smoke if you want, cigarettes, cigars, whatever you want.
Yeah, that's you.
Just breaking all the rules.
Oh, yeah, completely. Let's not get carried away. We'll just curse.
Matt Miskin of John Hancock. Lyngen of BMO writing, the primary risk of a 50 basis point cut is that the market translates the move into a series of 50 basis point reductions. That quickly brings the Fed funds rate back to neutral, thereby effectively cutting for the Fed and potentially stoking reflation. Ian joins us now for more. Ian, it's good to see you, sir. Thanks for joining us.
Thanks for having me on.
I want to start with your note from yesterday and pick out another quote. Can we expect, quote, a notably quick pace of cuts in the absence of more meaningful downside in the real economy? Said differently, will the Fed simply mark to market the dot plot, or are investors in for a surprise? What's your base case?
So I think they should go 25, but I suspect that if we go into the event priced with a higher than 80% probability of 50, that there's a really good chance that they move 50 simply to front load the process. Now, this becomes tricky for the Fed from a communications perspective, because recall what happened in June. We went into the June FOMC decision, they'd already submitted their dots. And so if it is a game time decision, we're walking in, we're going to get 50, but it's going to be hawkish, or 25, and it's going to be dovish.
So Ian, let's talk about retail sales and how that might influence things. Are you saying it's not that they're data point dependent, it's that that data point could shift market expectations so close to 50 they won't want to disappoint them?
Only if it's really weak. If it comes in stronger, it's not going to be part of the analysis, because we already know that the consumer remains on relatively strong footing. But if we see a negative print, particularly in that control group, that probably tips the scale to 50.
What are we pricing in right now in the rates market? We've heard a lot of people disagree around this table. Some people saying it is accurately pricing in about a 40% chance of recession, which is the baseline for Bank of America, the fund manager survey that just came out. Other people saying it prices in a much bigger tail risk of something that's negative. What's your take?
So when I look at the futures market, what I see is the market expects the Fed to get back to neutral, but not end up cutting into the one-handle territory. So that implies that, at least from a monetary policy perspective, we're still in a soft landing narrative. Now, 10-year yields close to 350 suggests that we're in for some economic downside over the course of the next 2 or 3 years, which I certainly agree with, but I do think that the soft landing narrative can probably survive this year, particularly if the Fed is a bit proactive. And even if we see a little bit of weakness towards the end of the year, the market will still think that it's alive.
Do you not buy the argument that they're just trying to get back to neutral, so they're not increasing their restrictiveness? In other words, does that hold less weight for you when you don't have clarity over what they believe the neutral rate to actually be?
Well, one thing we know is true is that as realized inflation decreases on a year-over-year basis, that means that real policy rates are more restrictive. So given where we are in the cycle, they need to cut rates just to keep the prevailing level of real rates as high as they are.
Ian, if we get a softer retail sales print and we have the Fed coming, or the market starts pricing in 50, more notably, not on a knife's edge, really starting for 50, but the Fed comes out and does 25, what happens to the market?
I think it all depends on how Powell spins it, and it all depends on what the dot plot tells us. Because recall that in June, the 2024 dot was 5.1, 2025 was 4.1. If we look at what's priced into the market, to simply mark to market, do we have to get to 3%? And so if the Fed says, okay, we're going to neutral, that gets us to 3%, and they do that via the 2025 dot, I think that the market doesn't sell off as much as it would otherwise.
You mentioned the risk of stoking reinflation or reflation. Bill Dudley yesterday, formerly of the New York Fed, wrote in Bloomberg Opinion, he thinks they should go big, he thinks they will go big. And he asked himself this question: do downside risk to employment outweigh upside risk to inflation? I'm going to address you with that question. Do you think they do?
Well, they certainly did throughout the bulk of this cycle. Now we're at the point where we have seen the unemployment rate materially increase off of the cycle low. The conversation about whether we're overdue for a spike higher in unemployment remains very valid. In effect, what the Fed is doing is they're changing monetary policy for the second half of next year, not for the current data. So it's the trajectory of the prevailing data, and it might make sense to go big early with the expectations that they can solve next year's problem.
We keep saying the Fed, but when we're talking about the Fed, we're talking about a group of individual policymakers who apparently have some different views on where we are at the moment. And I wonder tomorrow, when that decision drops and we talk about the decision 25 versus 50, and then we go for the forecast, we'll just be talking about medians. Will that mask a great divide on this FOMC?
I think that it might. We also might see a dissent. There's nothing to suggest that everyone needs to vote in for 25 or 50. So I think that that could be another way to communicate to the market that it was a knife's edge decision and it's uncertain going forward.
Do you think that there's a chance of a 75 basis point rate cut because of Elizabeth Warren?
That's really not been top of mind recently.
The reason why I ask is because we were talking about it earlier, and as someone who's in this market, I wonder sort of whether people actually dismiss this, whether it's actually harmful to the functioning of the Federal Reserve, or basically just noise with people trying to get their voices heard.
I think the latter point. I think that they're just trying to be part of the macro conversation, and it's not going to be particularly influential for the FOMC.
I love that you got Lisa to say noise for you. To continue this conversation, joining us now is Blerina Uruci of T. Rowe Price. Blerina, let's get to this data. It seems to have settled absolutely nothing about whether we go 25 or 50 tomorrow afternoon. What's your base case now?
So I would say that what we discussed here in the past is still valid, that the Fed is data dependent, not data point dependent. And so I hope when they sit in their deliberations today and tomorrow, they'll look at what we've seen in the economy over the last 3 months. I would say before the quiet period, we didn't have an indication that they wanted to start this cutting cycle with a big cut, but it seems like perhaps we don't have as good a sense of how the Fed is interpreting the labor market data as we should. And so I think into the decision, it's really essentially a coin flip, and I don't disagree with market expectations here. I do think that the Fed perhaps is looking at the fall in vacancy rates, at the recent uptick in the unemployment rate, and the labor market differential from the consumer side of the data, and saying, okay, the labor market is really slowing down, and perhaps we are a bit behind the curve, and we want to take some insurance cuts early in the cycle. So I think it's completely possible that we get a 50 basis point cut tomorrow. And I do think that the summary of economic projections is probably going to show that the dot plot has 100 basis point worth of cuts for the year as a whole. And I think if you consider how the market deals with uncertainty, perhaps from the FOMC's perspective, it makes communication easier. They start with 50 basis points, and then the market can expect at the November and December meeting a couple of 25 basis point cuts.
You mentioned the SEP. Let's start there and we'll unpack the rest in just a moment. The summary of economic projections was last published on June 12th, and that is super stale. So we're going to see some major revisions to that one. You mentioned how the median dot would come down and show in basically 100 basis points of cuts for this year. Blerina, can you walk me through 2025? Where's that median dot for 25?
Right. I think you're absolutely right. We're going to get a much more dovish dot plot than we had in June. Just a reminder, in June, we had only one cut for this year. So the FOMC has really changed their assessment of the economy and of the cutting cycle. For next year, I don't expect changes. I think they're going to still have 4 cuts. It would be a very dovish surprise if they fully embrace market pricing and show 4 cuts this year and 6 cuts next year. It's a risk to my view, but I do think that shifting to 8 cuts over the next 15 months or so, it's already a very dovish move from the side of the Fed. And then if you consider where they had interest rates at the end of the cutting cycle, I think essentially what's happening is they're not changing their idea or their view of the destination and the long run rate. They're just bringing those cuts forward because the cooling in the labor market and in inflation is happening faster than they expected back in June.
Just to sort of build on that, there's this feeling that later this year it'll get that much more difficult for the Federal Reserve to project out some sort of path with potentially some different fiscal proposals that could come to the fore that could very much affect inflation. Do you expect that to be sort of hinted at or suggested, discussed by a Federal Reserve that has hinted about the deficit as well as some other government programs?
I do expect that the FOMC and Powell in particular during the press conference will be asked this question. I think they will stick with their mantra here that they take fiscal policy as given. I do think that they are for sure assessing risks around their outlook with regards to what will happen if we have tariffs across the board. I know that we've had tariffs in the past. It's a one-off shock to the price level, but we haven't had sustained high inflation at these levels for quite some decades. So what will it do to inflation expectations if you have another shock to prices? So I think this will be part of the deliberation. I do think that when they get asked directly about it, they're not going to comment. But for me, I think even setting aside fiscal policy uncertainty, I do have a more benign or optimistic interpretation of data, both from the labor market and activity, than the market seem to have. And I do think if the Fed front loads cuts and easing in financial conditions, that it's setting up the economy to perform quite well later this year and at the beginning of 2025. And I think this will put forward some challenges to them bringing inflation down to 2%.
Is there any chance that there's a risk that this could set up the economy to, besides doing quite well, potentially re-accelerate inflation, Blerina?
I think this is the key risk that people are not talking about anymore. I do think there is too much certainty priced in the market that the Fed is going to bring inflation down to 2%. And when I look at the progress we've made so far on goods disinflation, a lot of that has been driven by dollar strength, by weak import prices, improving supply chains. I don't expect that impulse to help the Fed quite as much. I get the idea that globally commodity prices are soft because we have a China slowdown in the picture, but we're seeing signs of gold and copper picking up, and I think that's basically a precursor to global commodity prices perhaps picking up, and that's not good news for the Fed. Cutting interest rates, the market is pricing more aggressive cuts from the Fed than, say, the ECB, Bank of Canada, or BOE at the moment. I think that's going to lead to some dollar weakness as well. So I'm not very optimistic that the disinflation in goods is going to be sustained. And I think we're going to have more volatility when it comes to domestic services prices and rent inflation. So too much uncertainty, in my view, is priced in with regards to bringing inflation down to 2%.
We've got to leave it there. We appreciate your insight going into the Federal Reserve decision tomorrow. Blerina Uruci of T. Rowe Price.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.